About 30 years ago, you could earn about $200 a week and you'd be able to live a comfortable life. With the right savings, you'd easily buy a house. However, these days, if you don't make more than $100,000 annually, you will be living from paycheck to paycheck, and definitely you'll never be able to make the down payment for the dream house. Well, that is the American reality. It is now a fact that many people attribute these high price rates to the involvement of the boomers. Is that really so? Will things return to normal when the baby boomer generation leaves the market? Or will things continue to get worse for future generations? Stay tuned, because the purpose of this video is to explain everything. The real reason behind why the death and reduction of baby boomers from the market is causing the middle class the new Great Depression. Let's start with how the Federal Reserve is slowly making life more difficult by the day. Everyone is at a loss, especially the youth who struggle in this epic duel of the Fed trying to suppress inflation and rising housing expenses. It is worth mentioning that the Federal Reserve decided not to amend the federal funds rate in June of 2023 after several raises. However, this decision will not offer much relief for people of young age who are interested in buying their first homes, especially in this environment of high interest rates. Talking about housing, let's start with rent. As of 15 years ago, $2,500 would have given you a very good two-bedroom apartment with all the necessary facilities and upgrades, but now that same amount would only have given you a studio apartment. The US housing system at present is having real troubles, and this is simply because of the severe policies implemented by the Federal Reserve in their bid to fight inflation, which is counter-effective. As the Fed intentionally tried to tamp down inflation, their actions coincidentally became a source of disorder in the housing market, which functions as a major factor in stimulating economic growth. Despite the Fed's actions to steady the economy, the sharp rise of mortgages to nearly 8% for a 30-year fixed carnet nowadays, compared to 2 years ago when they were just around 3%, constitutes a new set of challenges for aspiring property owners. Now, most of them do not want to move because the payments may be significantly higher and they could buy smaller homes. In this case, the United States housing market encounters a circumstance that denotes both an inventory and a geographical dearth where Americans who wish to rent, purchase, or relocate are hampered in fulfilling their desire to either rent, purchase, or relocate, while at some time exacerbating the housing system's instability. On top of this, inflation has a much deeper impact as it contributes to the current bank's liquidity constraints. A recent survey by Wallet Hub, conducted from May 29th to June 2nd, 2023, found that many people believe these rate hikes provide them with more reasons to hop deeper into debt than help them free their debt. Almost 1 in 4 people is concerned about whether they are to face their jobs under the ever-increasing interest rate policy of the Fed. Over 2 out of 5 participants are unsatisfied that more rate increases are expected. It is the total cost of interest charges that the Fed's 3/4 tightening lending criteria between March 2022 and May 2023 may inflate for 2024. It thus amounts to $33.4 billion. The financial difficulties, along with inflation and high housing costs, have contributed to the remarkable growth of the total household debt, which is worsening the situation not only for young working people, but also for those who are working to buy their own homes or to pay the mortgage. Now, that's not all. There's a rumor that things will improve when baby boomers retire from the financial market. But this is a farce to give hope to the people, because the massive exodus of the baby boomers would most likely lead to a dark period, as a study by IMF in 2000 had put it. The resurfacing of the theory does not necessarily support the idea that the retirements could trigger a long-term slump in equity prices. The theory contends that once the mass of often called baby boomers leaves the stock market, either when they retire and sell their stocks or liquidate their investments, the stock prices may falter during a period that could as well be prolonged. Despite this, the role of these principled actions is underestimated by not mentioning a few key factors. Initially, the habit of selling assignees, i.e. millennials and Gen Z, does not correspond with the presumption that they will immediately be able to buy. Plus, with the current inflation rate, income, purchasing power, the need to invest and investment preferences evidently differ between these age groups. Additionally, the theory assumes a simplistic view of market dynamics, failing to account for the complexities of global economic forces, technological advancements, and regulatory changes that can impact asset prices. just like the Federal Reserve did last year. Even if the millennials and Gen Z are willing to buy regardless of the strain financially and high inflation rate, the baby boomers are not willing to sell off their assets. The prospect of downsizing from larger homes presents challenges beyond just financial considerations for the baby boomers. Many currently find themselves in homes that have appreciated significantly in value, which can lead to substantial capital gains tax bills upon sale. For example, in a scenario where a couple bought a house for $100,000 in 1987 and sold it today at $2 million, they could face a capital gain of $1.4 million that may fetch them a substantial tax bill, as it is in California, where several other taxes would be added to it. Such tax obligations would reduce the earnings from the sale of their properties, which often is the main source of elderly people's income, making it difficult for them to have enough money for their retirement. Furthermore, the availability of suitable housing options for downsizing is limited, particularly in neighborhoods where older homeowners have long resided. Many areas are predominantly zoned for single-family homes, with few smaller or multi-family properties available. This scarcity of housing options, often called the missing middle in housing, complicates the downsizing process for older homeowners seeking to transition to smaller, more manageable living spaces. While some communities are beginning to address this issue by allowing for the construction of smaller-scale apartment buildings and accessory dwelling units, progress remains slow. These challenges underscore the complexities and barriers older homeowners face as they navigate the decision to sell their homes and plan for retirement amidst a changing housing landscape. Now, all of these troubles with housing and inflation are a pain, and that's even without talking about how all of these long-term lower down payment requirements are taking a lot out of anyone who takes them in the long run. I know you must have heard of the 20% magic number. Well, the magic is not for you. It's for the person offering it to you. Homeownership predicts with lower down payment upfront may be viewed initially by people to facilitate home ownership. However, with careful consideration, excess capital is not needed and can go to other productive purposes. However, these respective products contribute to the worsening situation as houses become more expensive in the long run and creditors get more money from buyers. It is widely believed that the down payment should be no less than 20% to avoid mortgage insurance, or MI, and about half of the buyers still wish to have more affordable options with a lower down payment, thereby paying more money for their mortgage insurance premiums during the course of their mortgage loan. For instance, a $200,000 mortgage could charge a 0.5% MI, at least in the lower range, which is $1,000 for a year. Definitely a financial commitment and responsibility that mortgage holders have to maintain. Moreover, lower down payments can lead to higher monthly mortgage payments and increased interest costs over the life of a loan. With less equity up front, buyers may also face higher interest rates and the requirement to pay MI, further stretching their financial resources. Additionally, the risk of negative equity looms large for buyers with minimal down payments, particularly if real estate prices decline. Being, quote, underwater on a mortgage could significantly impact a buyer's ability to sell the home or qualify for future loans, potentially setting them back financially. Thus, while lower down payment options may appear attractive initially, they can ultimately pose significant financial risks for buyers, exacerbating affordability challenges and contributing to instability in the housing market. For the next generation of Americans, these issues are becoming more complicated, and 70% of Americans in particular will tell you they have more money-related worries than before. We could say that this high level of anxiety is driven by a host of factors, the top of which is the rise in the cost of living, including rent, food, and utilities, which diminishes the power of the consumer. Additionally, nearly 60% of participants cite inflation as the primary cause of concern, followed by risks for overall economic stability, high interest rates, and persistent lack of money. Furthermore, recent banking crises, such as the failures of Silicon Valley Bank and Signature Bank, have fueled uncertainty about the health of the U.S. financial system. Confidence in America's banking system is alarmingly low, with only 13% of adults expressing high levels of confidence. The repercussions of these crises have left many Americans deeply concerned about their own financial security, exacerbating an already precarious situation. Adding to these dealings are the rising charges of debt. Many people work paycheck to paycheck. thus resorting to credit cards to meet their shortfalls. The accumulation of credit card debts and the escalation of delinquency ratios are direct indications of household debt burdens that become another factor critical for the economy. The higher earners earning $100,000 or more are also not excluded from financial problems, as many of them have admitted to feeling financially strained and suffering from a lack of emergency savings. Thank you for watching this video. Don't forget to like and subscribe for more videos on what's happening in the financial world around you.